Now that you understand your portfolio savings needs, retirement savings options, and the pros and cons of traditional and Roth contributions, you can develop your personalized order of operations for future accumulation. And if you're creating your financial plan together with a spouse or partner who has their own savings opportunities and access to retirement plans, this summary will be divided into two columns. Starting at the top, as I mentioned during the retirement savings option lesson, you may have mandatory savings requirements, such as automatic contributions to private or public pensions and Social Security. You will also pay Social Security tax if you have net self-employment income. Saving beyond the mandatory contributions, you may consider a few factors when establishing your order of operations for voluntary account contributions. First, do you already have enough net income to maintain your current living expenses with room to save and invest? If not, there are two sides to the solution: increasing income and/or reducing living expenses, both intentionally aligned with your unique values. Keep in mind that income does not have a ceiling, but expenses do have a floor. In this made-up example, the Sampleton family will have gross wages of around $325,000 this year, but require $125,000 to cover their after-tax living expenses. After the mandatory contributions, determine if you may receive any employer matching contributions to workplace retirement accounts or employer-sponsored health savings accounts. Even if you can't contribute up to the maximum limits to your 401k, 403b, simple IRA, or HSA as an employee, contributing enough to receive the full employer match should be prioritized. As I mentioned during the 401k lesson, we don't want to leave these funds on the table since employer matching contributions alone can compound into years of additional retirement income. After your mandatory and matched contributions, assuming you still have net income available to save, the following steps should consider tax location, tax rate arbitrage, and future distribution rules. Since this family's current taxable income is expected to fall within the 24% federal marginal tax bracket, but they expect it to fall below the 15% effective bracket during early retirement without income sources beyond their portfolio distributions, along with an intentional Roth conversion strategy, they will prioritize pre-tax account contributions. In this example, Susan has two tax advantage options. First, HSA contributions are prioritized over maxing out the 401k. That's because Susan's HSA contributions directly through payroll are excluded from both income and employment taxes, as we learned during the pay statement lessons. And since Susan's earnings exceed the Social Security wage base, her HSA contributions will be excluded from income tax and Medicare tax. After taking advantage of those tax rate arbitrage opportunities, Susan will contribute to her traditional IRA, then immediately convert it tax-free to her Roth IRA as a backdoor contribution. They would make direct Roth IRA contributions, but their household income is going to be too high. In terms of tax planning, she will also need to report her after-tax contribution and tax-free Roth conversion on Form 8606 with their tax return. If you'd like to revisit that unique strategy, please rewatch the Roth IRA lesson. Lastly, all remaining available savings will be contributed to their joint taxable brokerage accounts, providing liquidity and future income tax control they'll value in early retirement. Susan's HSA, 401k, Roth IRA, and taxable brokerage will all be invested by referencing their personalized asset allocation examples, aligning their investments' risk and return metrics with when they expect that money to meet their future living expenses. Now moving to Steve's column, he terminated employment earlier this year, so he no longer has workplace retirement savings options. And since Steve is younger than 55, he cannot make a catch-up contribution to his own HSA. Unlike Susan, Steve has a significant pre-tax traditional IRA balance that cannot be transferred into a 401k, so he will skip the traditional IRA contribution and backdoor Roth conversion on his side. So that leaves the taxable brokerage accounts for any additional funds coming his way this year. Keep in mind that the savings order of operations does not only apply to pre-retirees. You may continue saving even after you stop working, whether you receive passive income or RMDs that exceed your current living expenses, accept gifts or inheritance from other family members, or continue contributing to HSAs under age 65, which does not require earned income. It's comforting to have a custom process in place for how to treat any funds that come your way, whether they can be contributed to retirement accounts or not. To finalize, with your savings order of operations in place, you may write additional details to explain your reasoning. It's often easy to forget how we came up with our ideas. Not only will you know what to do and how to do it, you'll know why the intentional decisions align with your unique financial situation and desired outcomes. Beginning with the end in mind, please watch the following 2 lessons to confirm your savings order. You will also learn how to create a distribution order of operations to visualize how you'll expect to receive future income from various sources.